Hi, I'm Paul with Clearstone Wealth Management. Over the years, I've looked at hundreds of 401k statements and have reviewed dozens and dozens of 401k plans with the goal of trying to help investors get the most out of their plan and, quite frankly, to help plan sponsors create a plan that's going to be the most beneficial to them. Now, what I've found is that investors are making some mistakes, and of the ones that I've seen, here are 5 of the most common, and I want to bring those to your attention so that maybe in identifying them, you'll be able to avoid them in your situation, thereby resulting in a more satisfying outcome in your 401k. Well, the first mistake that I've seen is that employees are just turning down free money. In other words, the employer is saying to the employee, here, I want to give you a few $100s every year or a few $1,000s every year. And the employee is saying, well, you know what? No, I don't really want that. So what do we mean by free money? Most of the time, a 401k plan will have a matching element. By that I mean if the employee participates, the employer will match whatever the employee puts in up to a certain point. Now, it could be a 100% match. The employer could say, if you put in, we'll say 3% of your salary, I'll put in the same amount. Or it could be a partial match, 50%, for example. The point is, if you don't participate in the plan, you're turning down the free money and you're not going to get it. And that can have a huge impact on your retirement. Let's look at an example. Let's say we have Bill. Bill just graduated from college, and he's going to make $40,000 his first year. We're going to say that Bill is going to work for 40 years, and I'm going to be really conservative. Bill is only going to have an annual raise of about 1.5%. He's going to contribute 4% of his salary to his 401k, which would be $1,600 a year or less than $150 a month. In the 401k plan that his company has, the employer agrees to match 50% of whatever the employee puts in. So in this case, the employer will put in 2%. Now let's also assume that over the years, Bill's investment portfolio will have about a 6% annual return. Now we're 40 years later, and we can see that his portfolio, his investment has gone up to where he has over $460,000 in his retirement account. Out of that amount, the employer has provided more than $150,000, which is the free money that Bill would not have gotten had he not participated in the plan. Turning down free money can have a devastating impact on your retirement. And I, quite frankly, don't know why people do it, but I see it all the time. The second mistake that I see has to do with the lack of training we may have received on investing. We begin to pick everything. Now, most of us have heard the saying, we don't want to put our eggs in one basket. And by that I mean in investing, we use that to say we need to diversify. We don't want to just have one fund in our retirement plan. And we agree with that. Unfortunately, because we haven't had the training, we just put in a bunch of the same eggs. Here's what it looks like. We look at the menu of options, investment options in our 401k plan, and we see 4 or 5 different large cap funds. And we don't really know any better, so we pick 4 of them because they all look like they've been doing pretty good. And then we know we should have some bonds, and so we look at the bond menu and we see 3 or 4 high yield bonds that have also done pretty good, and so we pick those. And somewhere in the back of our mind, we think we should have some international funds, and so we pick a couple of those. And we do this until we're just overlapping one another. So those 4 large cap funds that we selected may look good on paper, but if we get behind or we look inside of those funds, we're finding that they're investing in pretty much the same companies. They're investing in large companies like Microsoft and Amazon and Caterpillar and whatever else there might be. So we haven't really diversified. We've simply added 2 or 3 of the same kinds of funds. And we think in that we've protected ourselves when in fact we're actually carrying more risk. The third mistake that we make has to do with our behavior. I think most of us would agree that the smart investor has learned how to buy low and sell high. If we invest in a house, for example, we want to buy a house at a low price, maybe do some painting and remodeling, and flip it for a high price. Makes sense, right? The same thing is true for investing. We want to buy an asset when it's low. We don't want to sell it until it's high. The problem that I've seen is that we're human. And because we're human, when the market goes down or when we see our 401k account statement and we find that it's losing value, we begin to panic and then we begin to sell. Selling funds when their value is low can turn a paper loss into a real loss. Even though our statement said that our account has gone down by 5%, which might be $5,000 or $10,000 or $20,000 since the first of the month, doesn't mean that that's an actual loss, because if we don't sell it, it could easily go back up the next month. But if we panic, we're going to lose whatever value that we have lost because we've sold low. Investors oftentimes will follow an emotional rather than a disciplined strategy. It looks something like this. We open up our 401k and we feel pretty optimistic, and then the market goes up and now we're enthusiastic. Look at the money we're making. If the market continues to go up, we begin to feel a little bit euphoric, exuberant. We're really happy that we've done this. But guess what? When the market goes up, eventually it will come down. We don't know when, we don't know how long. We just know that historically we can expect it to go down. And when it does, we can become anxious. If it goes down even further, we can even be in denial. The market's not going to go down very far. This is it. It's bottoming out. If it continues to go down, we become fearful and we panic, and eventually we capitulate and we sell. What have we done? We have sold when the value of the asset is low because we're afraid it's going to continue to drop. And then what happens? Well, once again, we can't guarantee the market's going to go up, but we can look back historically and make a reasonable guess that a declining market eventually will give way to a rising market. And eventually, we'll say in this story, it does. Well, now we have hope. We see the market returning, and we're relieved because it continues to go up, and then we feel optimistic, and so we get back in the market. And we're buying high. So what we've done is the exact opposite of what we need to do because we've allowed our behavior to rule our decisions. The fourth mistake has to do with something called target date funds. Oftentimes, a 401k investor can have an over-reliance on these funds to their own harm. And I see some problems with it. Well, first of all, what is a target date fund? A target date fund consists of multiple assets that are chosen for you and balanced in accordance to your age or in accordance to the time that you expect to be working before retirement. So we'll just call it age for simplicity's sake. Balanced in a way that whereby the younger investor will have a more aggressive position in equities, and an older investor typically will have a less aggressive position in equities. Well, here are my concerns. The allocation has nothing to do with the investment risk that the investor is willing to take. Only the expected time that they're going to be in the fund. So, for example, a young investor with a target date fund may see that they're invested in 80% in equities and 20% in bonds. while an older investor, someone who is closing in on retirement, may have 40% of their investment in bonds, 40% in cash, and only 20% in equities. But what if that young investor is a little more concerned about the risk of being in the market? Well, in that case, that target date fund is too aggressive for him or her. And what if that investor approaching retirement really isn't concerned about the market and, in fact, has other assets available to him or her to mitigate some of the risk? Well, in that case, their investment is too conservative. The second concern that I have is that the investor in a target date fund is not able to select the assets that the fund holds. The target date fund is typically sponsored by an investment company, and we'll say that it is sponsored by ABC Investment Company. ABC Investment Company has this umbrella called a target date fund, and underneath this umbrella are several assets that comprise the fund. And the asset might be ABC Large Cap Fund, ABC Small Cap Fund, ABC Value Fund, ABC International Fund, ABC Emerging Market Fund, ABC Real Estate Fund, ABC Long-Term Bond Fund, ABC. Here's the problem. ABC might have a great large cap fund and a lousy international fund. But if you're an ABC Investment Company's target date fund, you get all of their investments. You get what they pick, and chances are they're going to pick their funds. Thirdly, and I don't know why this is true, but I've seen it time and again, younger investors have a tendency to select funds intended for someone older. Now remember what I said? A target date fund typically has a more aggressive position in equities as we're younger. But what a younger investor will do is lie about his or her age and find themselves in a more conservatively positioned target date fund, which provides less of a return, which could impact the long-term outcome of their retirement fund. So be careful. Those are my concerns. Here's mistake number 5. I don't know how many times I've talked to somebody who said this or something like it. I don't really look at my 401k statement. I just have money taken out, money put in, and I'm hoping for the best. Do you see the problem with this? Well, among other things, the devastating and negative impact of this negligence may not be seen until it's too late or it's too painful to do anything about it. We believe that at least once each year, the 401k fund should be looked at, the portfolio should be looked at and intentionally rebalanced to reflect the intention of the investor. What do we mean by rebalancing? Using this simple illustration, let's say that we have an investor who wants to have 50% of her stocks or her portfolio invested in stocks and 50% in bonds. Now look at the chart on the right. Over the last 10 years, we've been in a bull market, and if this investor didn't do anything about their portfolio, even though they wanted a 50-50 split between stocks and bonds, the value of the stocks have gone up to where it could easily represent about 90% of the fund value. So they're out of balance. Now look at the chart on the left, and what you'll see is that what we've tried to do is maintain that equilibrium between stocks and bonds by rebalancing it every year. If stocks have gone up, we sold some stocks, we bought bonds that have gone down in value. If bonds have gone up, we sold bonds and we bought stocks that have gone down in value. What have we done? We're buying low and selling high. And we're also stabilizing the level of risk, at least annually. Your 401k portfolio account should be rebalanced to bring it back to the level of stocks and bonds and other investments that are important to you. Well, those are the most common mistakes that we've found, but we've also found that with just a little effort, you can avoid those mistakes and you can enjoy a more rewarding retirement. Well, once again, I'm Paul with Clearstone Wealth Management. We provide personal wealth management. By that I mean we do goal-based financial planning to make sure that we understand what's important to you and your loved ones in your life, and then we create customized portfolios and manage those portfolios to make certain that they're in line with what's important to you. My contact information is on the right. I'd love to hear from you. Give me a call, drop me a line. Thanks once again.